Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, April 3rd, 2020. Here are our top stories. 401k plan employer contributions fall victim to the virus, and the virus also slows merger and acquisition activity. Joining me now is Devin Banerjee. He's a senior financial services editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, thanks so much for joining me this morning.
Always a pleasure, Jeff.
Yeah, it's great to see you. How are things going working remotely? How are your LinkedIn colleagues around the globe before we begin?
Thanks. Yeah, fortunately, we're all working pretty well, collaborating across the globe. We are in every time zone, keeping the news module up 24 hours a day. So thankfully, doing well so far.
That's great. Great to hear. And the coronavirus information that you're putting forth, in addition to everything you're doing, is really important. So thanks for doing that. I'm sure a lot of people get a lot of great information. So Devin, lots going on in the space. I mean, there's the markets, there's the things with the virus, people being affected all around the world. But what's top of mind for you and your team at LinkedIn?
Yeah, absolutely, Jeff. So the past couple of weeks, you and I have been talking about several things that are kind of hearkening back to actions we saw in the wake of the 2008-2009 financial crisis. Yeah. Another one that's coming up now is companies looking, when they're thinking about cost containment, just like consumers are thinking about tightening their belt, and companies are looking at their liquidity and their cash flow positions and making those resource and capital allocation decisions. We're starting to see them reduce the amount they're contributing to employee retirement plans, to 401k plans, for example. And this was something we saw in the wake of the financial crisis. About 20% of large employers in 2008 and 2009 pursued this route as well. So we're seeing this wave now with some major companies, Marriott being one of them, Macy's being one of them. I know you've been following some others, Jeff, like Amtrak, Mattress Firm. These are among the companies that we're seeing either delay, reduce, or suspend that 401k matching program. And this, as you know very well, is reversing actually a major trend that we've seen in recent years in that really tight labor market that we used to have. Companies were really increasing their employee benefits, including ramping up those matching percentages, those matching volumes for employee retirement funds to attract and retain workers. So we're seeing that reverse. Now, of course, what does this mean for workers and employees? That's what's really important. Well, they're kind of taking a double hit, if you will. One, their balances have been hit, of course, if they're exposed to the equity market in those plans, or frankly, if they're exposed to any mix of asset classes right now. So they're taking that hit in their balance, and now also in what they're getting in employer contribution and employer matching. Now, also, when you think about where depressed levels of asset classes are now, there's less in that employer contribution being purchased or effectively being used to purchase those funds or whatever they've chosen for their retirement fund. So less is being invested at these lower asset price levels, which would be beneficial if more was being invested now. And the last one I'll mention is kind of this behavioral element. A lot of people kind of look to their employer for guidance in terms of how much they should contribute themselves from employee paychecks into their plan. So there's that golden rule that, of course, if I can just generalize, is typically to at least contribute as much yourself from your own paycheck to obtain your full employer match. If that full employer match is going to go down, we may see people reduce how much they themselves are contributing, especially as they're looking, as I said, to cut their own spending and boost their own savings. So there are all those three factors and more affecting workers right now when it comes to this trend.
And Devin, thanks for that. And I think it's just kind of obviously it's a sign of the times, a sad state of affairs. We've talked a lot on this program and in other venues over the years about saving. And you're right, the match and the average match is the 50% of the first 6%. Right. Is such an incentive for people. So to see that disrupted again for the first time since 2008, 2009, obviously very disheartening. I really feel like, and we had a great interview yesterday with Neil Lloyd from Mercer Consulting, who leads their financial wellness research practice. And his opinion, and I share the opinion, is that we're all in survival mode. And what does that mean? Yeah. Well, the markets are down 30%, but we're just trying to make our ends meet. We're trying to make sure that we can meet our budgets. We're all working from home. We may or may not have our jobs. We may be furloughed. We may not even have health care. At the same time, businesses, as you said, are making those important decisions. So this is certainly a sad part of what's happening, but it just is. It is what it is.
I think that's a great point you're making, Jeff, which is, yes, it's disheartening, but if you kind of think about the layers that are impacted first as companies weigh and balance these decisions they have to make, there's of course jobs first. People are losing jobs or people are being furloughed. Then there's pay. There's base pay that's being reduced quite drastically in many companies. Then there are other benefits, health benefits, which arguably are more important or at least more critical in the short term than retirement benefits. Mm-hmm. So there certainly are these layers being taken down first before you hit this topic we're talking about. So certainly this is disheartening, but others are being affected in much more high impact, tangible ways. And one more data point I'd mentioned from Willis Towers Watson, which is one of the largest advisors and consultants when it comes to employee benefit plans, is that in the past crisis, for those companies that did reduce or suspend their matching programs for retirement funds, they did so, the median term that they did so was about 12 months. So of course, this could just be a temporary issue as companies assess their cash flow and liquidity positions, and we could just see these programs return to their original state potentially a year or so from now, depending on how long this all takes.
Yeah, and I agree. I think things will come back. The markets, jobs, we have to get through, obviously, what are going to be very trying times. And we know from the coronavirus task force and the press conferences and the information we're getting is that we're expecting very difficult times ahead. A couple of things that I just want to point out, Devin. Number one, you mentioned some very large firms. Some of those firms that have issued employer stock, if people have that in their 401k plans, and they're allowed to do that, there's certain limitations there that came as a result of some other issues earlier on in the early 2000s. That's a real concern. But the other thing is small employers. These small businesses already challenged. They're getting some incentives to keep people on the payroll, but we could see small employers do away completely with the retirement benefits, which again is something we completely do not want.
Yeah, and to the point you made a couple of minutes ago, this is just a sign of the times and a reversal of so many great trends we were seeing in terms of employers upping those benefits. Also, the new law that went into effect a couple of months ago that allowed multiple employer plans for small businesses to start thinking more more wisely about this benefit. So unfortunately, this is a sign of just how severe this crisis is and how far, how deep it's reaching into people's pockets and companies' strategies around benefits.
Absolutely. Well, we're going to both remain optimistic. The audience should remain optimistic, and we'll get through it. Devin, I want to hold you over. When we come back, we're going to talk to Devin about M&A activity and what he sees in terms of news there. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive FIBREX composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee. He's the Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which wraps up all the news and analyzes all the news in markets, and you can check that out on the LinkedIn platform. Devin, thanks so much for sticking around this morning.
Absolutely, Jeff. Happy to.
So I think we ended kind of on a positive note. We shall overcome everything. We've overcome things in the past. We will do this again. A lot of challenges, but you also have taken a look at the merger and acquisition industry and what some of the transactions that have and have not been happening. What can you tell us there about some of the activity?
That's right, Jeff. Just another sign of the times or a casualty of this crisis. We really were in a golden age for M&A the past few years. Just in the past 5 years, $18 trillion in announcements were made, and some of the biggest deals we've ever seen. If you remember, AT&T, Time Warner, AB InBev, SAB Miller, and we've really seen those numbers now come down, of course, as boardroom confidence, CEO confidence has really taken a hit, and their priorities have shifted to their workforces and to their current businesses. So what does the data show? So the data shows globally, M&A this month is down about 18% year over year from March of last year. This is according to Deal Logic. Year to date, it's now down almost 10% globally. In the U.S., activity was outpacing last year's activity until this month, so that trend has reversed here in the U.S. And just recently, I got some real great insight on the M&A market from Neil Dar. He's the U.S. financial services leader at PwC, and I'm just going to share a couple of his takeaways. Neil expects a total pause in M&A. He says, if you think about it, number one, it's extremely difficult, if not impossible, to conduct due diligence right now, which is a key critical component of coming to a deal agreement and pursuing a deal. Travel restrictions, you can't travel. One banker told Barron's, how can you do a deal if you can't look your counterparty in the face? And of course, doing diligence on the business, doing diligence on the health of workforces is really, really complex and if not impossible to do right now. Number two, it's really difficult to price risk. This is a really important component of deal making, which is to look at different scenarios for the target business and effectively price the deal based on probabilities of those different scenarios. In this kind of economic uncertainty, it's very, very difficult to do that. And number three, I'll just mention the volatility in the capital markets we've seen has made securing financing for deals, obtaining that debt at the right price or obtaining it at all, very, very challenging. So what Neil says you can look for going forward, of course, he says, as I said, expect a pause in M&A. Also expect some scrutiny around already announced but not completed deals. There's something called MAC clauses in agreements, material adverse change clauses, which allow for deals to be renegotiated, repriced, or terminated if a material adverse change occurs. A lot of lawyers are now carefully studying the language that was put in place for some of those announced deals. Neil also says expect some more stock for stock deals, as stocks of both targets and acquirers have kind of both been hammered together. He also says expect companies, when they're looking for alternative avenues for growth right now during this environment, they may look to spin-offs or split-offs of different parts of their businesses, putting those up for sales. He says expect some more of those. And yeah, we saw this today. Full disclosure, we're filming on Wednesday of this week. We saw Xerox drop its $34 billion bid for HP after stocks of both of those companies were completely hammered. Xerox also dropped its proxy battle to replace HP's board. We're seeing a lot of those proxy fights rethink their strategies right now. And again, as I mentioned, a lot of companies are just looking internally now during this period of crisis, thinking about the health of their workforces, getting accustomed to virtual working. It sounds kind of surface level, but it's effectively what everyone has to do right now. And then, of course, focusing on their current business models, their current customers, their current clients, and just trying to maintain business. So basically, all of those big inorganic strategies around M&A have basically been put on ice right now.
Yeah, it seems like that is very consistent, for example, with the real estate market, which we have also seen both the commercial real estate, but also private residential real estate looks like it's on pause. And, you just look at, we're all working from home, we're working remotely, we're trying to keep ourselves going. I think you're right. The focus is now on day-to-day operations, as you said, the health of the workforce. And really interesting, Devin, the retirement industry is one area where you have seen a lot of M&A and acquisition. So record keepers are buying other people record keeping, asset managers buying other asset managers. And I would presume that like every other aspect of the marketplace, that's on pause as well, because you don't know what you can't get on site. And that, a lot of these businesses are people businesses. If you don't have, we use a lot of technology, but if you can't assess people, where are you?
Absolutely. And actually, in terms of the nature of work for bankers and investment banks, we're seeing that totally change. There was a great Bloomberg story about a week ago about how there was one banker in London that Bloomberg quoted who rushed out new business cards to change his title from M&A advisory to M&A and restructuring advisory, because so many clients are turning away from those big mega deal strategies and now just focusing on their own liquidity positions, their balance sheets, trying to raise capital, trying to prevent their looming cash crunches themselves, and are now looking for restructuring advisors versus M&A advisors. So the whole nature of investment banking and that work has completely changed. And a lot of bankers are saying, they're happy to do that even on a retainer basis and to become that trusted advisor, because if and when all of this resolves, it could lead to those big M&A mandates for them from their clients when the M&A appetite returns.
Yeah, and also let's not forget the IPO market, which is already kind of slow. There was very decisive moves to take companies public. I have to imagine that likewise in today's environment, those are on pause as well. Certainly overall not a good thing, but leaving on a positive note, these things are temporary. We'll get through it. And I know I can say that. I think you feel the same way. And I think there are many people out there who have a lot of faith. So Devin, we're going to have to leave it there. Thanks so much for joining us. As always, appreciate your perspective, and stay safe. You and your family stay safe.
Thanks, Jeff. Take care.
And that wraps up this episode of BRN AM, and it wraps up our weekly episodes of BRN AM. But we're not done for the week, because tomorrow we've got our weekly show, BRN Weekly, which features a very special guest. And we'll also take a look back at the hottest segments for the week. You're not going to want to miss it. Don't forget, as always, you can get all the latest news in retirement markets, technology, personal finance, and so much more. Check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, stay safe, and don't forget, roll with the changes.
Waiting here for you to take and drink of. tired of the same old stuff.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.